As a former IRS auditor, I've seen so many cases of gig economy independent contractors, such as those working with Lyft, Uber and Ubereats, Doordash, Grubhub, Instacart, Roadie, and Walmart Spark, struggling with the mileage deduction. Surprisingly, a lot of contractors don't report enough mileage and are paying too much in federal taxes. So I'm going to go over how you can track your mileage, how to calculate your mileage so that you don't have a tax loss, and later in the video, I will go over a way that you can possibly increase your mileage deduction even more. I'm not giving you tax advice here. I'm just giving you some information so you can work together with your tax advisor to maximize your mileage deduction. In my opinion, if you do a lot of driving for gig apps, you should never have a large tax bill because you're putting so many miles on your vehicle. I know that companies such as Uber and Lyft will provide a year-end statement to contractors showing their mileage for the year, and an IRS auditor will absolutely accept the mileage listed on the statement. But you are losing because the mileage shown on the statement is only while you are on a trip or delivery. It doesn't include mileage to a pickup or after a drop-off. There are two ways to count mileage. The first way is when you don't have a regular office space. In this case, you count your mileage when you pick up your first rider or reach your first business destination. For food delivery, this would be the first restaurant where you are picking up. For grocery delivery, this would be the store for your first pickup. Your mileage stops once you drop off your last passenger or make your last delivery for the day. This means that all mileage between your first business stop and your last business stop is deductible. A strategy that you can use is to try to start calculating your miles as close to your starting point as possible. So if you start from your home, then you want to have your first pickup as close to your home as possible. For example, if you normally go to the airport to pick up rides, instead of driving all the way to the airport without picking up a rider, pick up at least one ride closer to your home. Then you can start calculating your mileage once you pick up that rider. Now all the miles after that, until you drop off your last passenger for the day, can be counted. An easy way to keep track of your mileage is to keep a log where on any day that you do gig work, you record your odometer reading once you arrive at your first business stop, and record your odometer reading at the location where you drop off your last passenger or delivery. In addition to your odometer readings or the number of miles that you drove, please make sure that your mileage log has the date, the address of the first pickup, the address of your last drop-off, the business purpose, and any tolls or parking costs related to your gig business. Please make sure to keep receipts for parking and tolls. You should update your log anytime you use your car for your business, even if you're working every day. So please do not wait and try to create the log at a later time. There are two methods that you can choose from to calculate your mileage. You can either use the standard IRS mileage rate or actual expenses. Please keep in mind that if you use either one of these methods, once you stop using your car for business, it's possible that you may have a gain or loss for tax purposes. If you use multiple vehicles, you do not have to use the same method for all vehicles. If you use actual expenses for the first year that you use the vehicle for business, then you will have to continue to use actual expenses each year that you use that specific vehicle for your business. If you choose to deduct actual expenses, you will need to keep receipts or invoices for vehicle expenses such as gas, oil, repairs, insurance, maintenance, and lease or rental payments. If you own the vehicle, you can also deduct depreciation on the vehicle until it is fully depreciated. If you rent a vehicle, you can only use actual expenses. If you rent or borrow a vehicle, you cannot deduct owner-type expenses such as depreciation or registration fees. So if you rent a car, you can deduct the business portion of rental fees and gas, but you cannot deduct the mileage. If you use actual expenses, along with your mileage log, you will need to record your odometer reading at both the beginning and end of the year as well. If you are just starting your gig business, you can use the odometer reading on the date you start using your vehicle for business. For your federal taxes, you will divide the number of miles that you drove for business by the total number of miles that you drove for the year. You will multiply this percentage by all of your vehicle expenses to get your tax deduction. For instance, if you drove 15,000 miles for gig work and 25,000 miles for both gig work and personal purposes for the year, and you had a total of $5,000 in vehicle expenses, your business percentage would be 60%, and your tax deduction for vehicle expenses would be $3,000. If you want to be able to switch back and forth between using actual expenses or the standard mileage rate from year to year, then you must use the standard mileage rate the first year that you use your vehicle for your gig business. After the first year, you can use either actual expenses or the standard mileage rate. A common strategy is to calculate your deduction under both methods and then go with the one that will give you the largest tax deduction. Let's look at the standard mileage rate and how you can make sure that you are not working at a tax loss. For example, the standard mileage rate for 2024 is 67 cents. You should double this amount to account for the miles that it takes to get back to an area with restaurants or shopping centers. Even if you don't have to return to a certain area, you still have to consider the miles that it takes to get to your next stop. So doubling the standard mileage rate is a safe way to avoid taking a loss. The 2024 standard mileage rate doubled is $1.34, but I'm going to go ahead and round it to $1.35. So at a minimum, you would want your offer amount to be $1.35 multiplied by the number of miles. So for say a 4-mile trip, you wouldn't accept anything lower than $5.40. Now for 2024, the $1.35 per mile is basically a break-even amount. If you want to make a profit, you should accept jobs that are more than $1.35 per mile. Although this probably won't apply to most gig contractors, you cannot use the standard mileage rate in the following cases. If you claimed a depreciation deduction for your vehicle using any method other than straight-line depreciation. If you claimed a Section 179 deduction or any other special depreciation allowance on your vehicle. If you claimed actual car expenses for a leased car. If you are a mail carrier who receives a qualified reimbursement, or if you use 5 or more cars at the same time, such as a fleet. If you're just swapping out and using cars for your business at different times, then you are not using multiple cars at the same time. If you lease a vehicle and use actual expenses, you cannot take depreciation on the vehicle. You will deduct the business portion of the lease payment instead. You will deduct any advanced lease payments over the entire lease period. If you are actually buying a vehicle but the payments are called lease payments, you cannot deduct these payments. Now, if you use the standard mileage rate, your lease payment is not deductible at all. If you want to use the standard mileage rate for a car you lease, you must use the standard mileage rate for the entire lease period. If you lease or rent a vehicle, you may have to reduce your deduction by an inclusion amount. We won't get into how to calculate the inclusion amount because that's an entire topic by itself, but please keep in mind that if you lease or rent, you may have to reduce your deduction each year. I want to take a moment here to talk about a gray area in the tax law regarding vehicle expenses. The IRS does not provide clear guidance on what to do if you borrow a vehicle to use in business. I reached out to some old colleagues at the IRS and the IRS helpline to see if there has been any update regarding borrowed vehicles, but there hasn't been an update at this time. Some tax advisors will tell you that you cannot take actual expenses, while others will tell you that you can take the expenses. When I was an IRS auditor, I would allow actual vehicle expenses on a borrowed vehicle. Some auditors may not. So as of now, in 2024, if you borrow a vehicle for business, you will have to discuss with your tax advisor how to handle any expenses and decide whether it is too risky to take a deduction for gasoline or other repairs that you make on the vehicle. But no matter what, unless the vehicle belongs to your spouse, you can never use the standard mileage rate for a borrowed vehicle. This means that you cannot use the standard mileage rate even if you borrow a vehicle owned by your parents and you are their dependent. If you're super nervous about taking a deduction for vehicle expenses on a borrowed vehicle, you can consider entering into a rental agreement with the owner of the vehicle to pay the owner to use the vehicle. The owner would have to report income for the payments received. The catch-22 is since the owner is not in the rental business, the owner won't be able to take any deductions for renting the vehicle to you. Now, if you enter into a rental agreement, the IRS wants the rental amount to be reasonable. The rental payment would have to be around the same amount that you would pay to a stranger. So, you might not get away with paying your mom a few dollars to use her car. Finally, we are at the second way that you can count your mileage. This way requires an office or home office. If you have an office, you can count all the mileage from your office to your business stops instead of counting the mileage once you reach your first business stop. If you really want to supercharge your mileage deduction, you should consider setting up a home office. If your home office is your main business location, then you can calculate your mileage starting from your home and back to your home. Basically, you would be able to deduct round-trip mileage to and from your home. Another benefit to setting up a home office is that you may be able to deduct part of your expenses such as rent or mortgage interest, home depreciation, insurance, utilities, and repairs. Setting up a home office is available to both homeowners and renters. There are 3 requirements for your home to qualify as a home office. 1. The space or room can only be used for your business and absolutely nothing else. You can use a space within another room, but again, that particular space cannot be used for anything else. If you use space within another room, please just make sure that you use some type of partition to separate your office from the other space. 2, you have to use the space on a regular basis. And 3, your home must be your principal place of business. You can even establish a home office if you only use the office for administrative and managerial activities. But that's only if you don't have another place to do these things. I know that this was a lot of information, so if you need help filing your taxes and need an expert to help guide you, I have included a link to a tax service in the description box. By the way, if your business is an S corporation, you cannot take a deduction for vehicle expenses because you are an employee. You would have to establish an accountable plan and get reimbursed by the business instead. To learn more about accountable plans, please watch the video in the lower right of your screen. All the best.